Hi, this is Bill Boerum and my very good friend and colleague, Joel Zizmor. And we've had two careers in the financial services industry. And we're going to have a conversation about things happening in the banking system and amongst individual banks this morning, talking about Silicon Valley Bank and all of the financial elements that went into the current crisis, if it can be called that. And we can start off first with letting our viewers know our highlights of our career backgrounds. And I hate to admit it, but Joel and I, he may not have calculated this morning, but I did, that we've known each other for over 50 years. And it didn't start in kindergarten, that's for sure. So, Joel, if you would talk about your background, and I'll let people know what I've been up to.
Thank you, Bill. Like you, I grew up in the New York City area. Went to high school there. My family immigrated there. Went to the University of Wisconsin. Met Bill while I was doing my MBA in finance at the Johnson School, and subsequently moved to California, where I've been since the 1970s. So I guess that makes me a native. The bottom line is I spent the better part of my career since the 70s in bank regulation with the Comptroller of the Currency, specializing in investment management. I was lead expert for capital markets for the Western United States, worked out of San Francisco, out of primarily large banks, large complex banks, and retired over 10 years ago. Did consulting work with a group we called ALM Consulting, and currently retired. And more than happy to talk with Bill all the time. So thank you.
Oh, that's thanks, Joel. Um, so I met Joel when we were both at the Johnson School of Cornell University in upstate New York. And as he mentioned, both of us from the New York City area. I went to Manhattan College and then on up north to Cornell. And after graduation, I went into the commercial banking industry and actually worked for three banks and finishing up with the Bank of California, today known as Union Bank. But I had also been for a period of time with Citicorp USA, as it was called, and in their International Financial Institutions Group. And in fact, most of my career in banking was on the account side, being an account manager for banks, primarily banks, but some other financial institutions. And it was quite an interesting experience. Got around the entire United States, every state, I must say. Maybe they'll put that on the tombstone. He visited all 50 states. In any event, uh, I'm kind of on the other side of the desk from where Joel sat, although he also went over to the other side of the desk later on as a consultant, as he mentioned, in behalf of client banks. So anyway, um, we wanted to talk, well, probably most of our conversation about Silicon Valley Bank. And I think I would ask Joel to start off from your perspective for a few minutes, talk about what went wrong at Silicon Valley Bank. Maybe not all the decisions, but in macro terms, what happened there?
Well, I think Silicon Valley Bank is a rather unique institution working in a rather unique marketplace. Number one, I think in order to be realistic and be humble, I think I would confess from my side that it is really difficult to know precisely what went on at Silicon Valley Bank because we certainly are not clear as to what the decision-making process was today or in the past. I can say I know several people there who I consider to be highly competent people. I can't entirely reconcile what I know of some of the people there with what the ultimate outcome was. So I think some of the things that are quite unique is this. unique to this bank compared to virtually any others. One, concentration risk. This is a remarkable bank with regard to concentration. One, client concentration, deposit concentration, marketplace concentration. It seems to me if you're going to look at what went wrong, you have to take a look and ask yourself precisely what did the bank do with regard to its deposit concentration. I can't speak to its lending concentration, but I would want to know the answers to that, and I suspect we will ultimately know. Um, their business model is clearly unique, taking in money from startup companies and then subsequently growing the bank just exponentially through startup money. And exactly how they allocated that money within the bank is, I think, will probably answer the question as to what went on there. It is pretty obvious they did not manage the concentration risk very well. Even though the concentrations were well known, I know there's a lot of speculation as to what happened there and why they went under, but I would suspect you're only seeing just some side effects. You're not actually seeing the causal factors. But I'd say the concentration of the bank is probably the single most important aspect of it. And I would also say that compared to past banking crises, the 80s, 90s, the 2008, 2009 period, the one thing that differs here is the fact that there is a very troubling role being played by social media and the internet and how communication took place there. Beyond that, I think we're going to have to wait for probably congressional hearings to find out exactly what the regulators did and what the banks did do, and of course, what they didn't do.
Right. Well, I think that sums it up very, very well. And I certainly would agree with you that an underlying factor, if it can be generalized, is concentration risk, both on the credit side, if you want to say the asset side was not on loans they extended, but really what they did with the money that was generated. I spent a lot of my career looking at credit risk, only a little bit at the liquidity risk, if you want to call it that. But we haven't heard much about their loan losses. They might have been astute lenders, as it turns out, although they concentrated, as you say, in that industry. I think the CEO maintains that they really didn't have concentration, that within the overall tech sector, there are smaller segments which different vary of risk. And of course, they also had a wine business. But I think fundamental to that issue was also that they were great relationship bankers. They caused people they made loans to them and they gave them their deposits. And the tech companies gushed with money, and the VCs gushed with money during an IPO boom. And all this money just bubbled up within Silicon Valley Bank, and they had to do something with it. So there was a good side to it, and they bubbled up. Then what do you do with it? They were astute, and they didn't lend it out, lend it as far as making loans, really extending credit. I think they were careful on those opportunities. But what they did with those deposit assets was to invest in long dated Treasury securities. And then, of course, the Fed, and we'll talk more about that, developed a rising rate scenario. And that's what caused them. But there were management mistakes along the way. But I agree with Joel on that, on the concentration risk element, and it really caught them short. So specifically, Joel, do you any management mistakes that you would highlight in the fact they had all this money and they invested it in long dated treasuries? Could they have undertaken? I think they did some hedging, but could that have helped them or ameliorated the risk?
Well, I think hedging deposits is a rather difficult task. First of all, it is questionable as to whether they actually understood the characteristics of their depositors to begin with, and the duration and volatility of their depositors. It's not likely. Large banks find it very difficult to do that. So I'm not sure that would have been practical. I think the main issue is I suspect that they really didn't have a clear look at the volatility and the stability of their deposit base. It has been reported that they had deposits had a deposit with a crypto firm as large as $3 billion, primarily uninsured. And I think that is indicative of the kind of, or the lack of sophistication on the part of the bank in taking those deposits, and an even lower level of sophistication for the depositor putting money in that position. Highly unusual, highly irregular. I personally have never heard of deposits of that size being placed in uninsured deposits. So I think that should have been a huge red flag, much of which was publicly known to the regulators and to the bank itself, obviously. I don't entirely understand the reasoning of the bankers as to why their deposit base was in some way more stable, or why their deposit base was not unique. It was very unique.
Well, one of the things that's curious to me we haven't learned, it's one thing where most of these deposits, demand deposits, as we would call them, but what's the structure of their time deposits? I mean, that was a cost to them as well. So, but I can't imagine that all these separate clients, many of whom with large balances, would have let them sit there simply as demand deposits. They must have had some kind of structure of time deposits also. We haven't heard anything about that. So that to me is a little bit odd. One of the other management mistakes, other than proactive hedging, and they let those hedges go off last year, was no chief risk officer for most of last year. So no one may be convening meetings of the Asset Liability Management Committee. I think maybe they did have some meetings, but were those several meetings in the last month or two, or were they periodic? So I question that. I think also there was a board advisory committee that did not have a chair to it. And then you go even more fundamentally to the board of directors, where these were Silicon Valley entrepreneurs primarily. Is that your understanding as well, that the board was really not a fiduciary type of board?
Well, that is my understanding. I mean, I don't personally know the backgrounds of each of the people sitting on the board, but that is my impression for what it's worth. I do know the CFO of the bank, the Silicon Valley Bank, is a technically highly competent asset liability management manager. I would love to share a drink and speak with him, but that'll have to happen on another day. I simply don't understand how there could have been this large of a mismatch, unrecognized by the bank, number one, and even more significantly, unrecognized by regulatory bodies, because it was clearly in the financial information. It was very significant. So I don't know what the discussions were, and perhaps one day we will know what the discussions were internally between the regulators and the bankers. But it just seems like the structure was simply too risky to avoid. It was just right there in the public statements.
Right. Joe, well, thinking back to, even though it was 10 years ago, things may have changed quite a bit. But back when I was in the business, there were banks that we were concerned about, and I was kind of a monitor of counterparty risk and of credit risk, but also looking at asset liability cap, if you will. We would get reports quarterly from some of the banks, not all of them, just the ones we want to look at, follow closely. Quarterly statement reports that they filed with the comptroller of the currency where you
Right.
used to work. And I can recall, looking at the current assets and current liabilities, especially looking at the investments and calculating a gap there. But that came in usually, it was quarter end. You might get it 45 days later from the bank. Uh, Generally, was when it was available. So, did the regulators routinely have, even in your last years, quarterly report? Well, you did have the quarterly reports.
Oh, absolutely. Yeah, I mean, it was very common to review asset liability management reports and bank structure reports and asset liability sensitivity reports and stress tests quarterly. But I think in banks of this size uh, and the major banks, it's not as if we had to wait for reports to show up on a quarterly basis. It was common that the person responsible for these banks literally were resident examiners. They were there all the time. They had a distinct relationship with the people in the bank. They should have had access to information online on their computer at any time of the day or night. So that is clearly that was not the case 20 years ago. This information should have been readily available. The person who was the chief financial officer of Silicon Valley Bank was a skilled modeler, a skilled asset liability tactician, in my experience from his previous work at previous banks. So I would say the information was there. What the regulators and the bankers did with it is another issue altogether. That remains unclear, and I suspect when we find out more, it'll probably be even more troubling. But we'll see soon enough.
Well, from the standpoint of a bank examination, um, what were kind of the categories, perhaps, that this kind of a bank with its mismatches would have been put into? My old corporate lending days, as I recall, we would look at the credits once a year and give them a category, which would be, I think, as I recall, it was probably satisfactory, watch list, substandard, doubtful, and loss. And that's what we did. And I think the examiners had the same set of categories, and you would take different actions for each of those categories. Is that kind of broad brush uh, how
Well,
what the examinations would result in?
right. I think for asset quality, clearly that's the case. I think for financial issues, they would have expected the bank to have an internal risk management system that identified these risks um, on a regular, routine basis. And I would have expected the examiners, as well as the board, to be getting these same reports every month, to be available every month. I am reasonably certain that this bank had access to relatively sophisticated modeling capability. The only reason I say that is because the people I know who work there were skilled at that kind of thing.
Right.
And it's 10 or 15 years ago. So the question is exactly what were they putting into those models? Did anyone care? Were they oversimplifying the models? Very possible. And the Asset Liability Management Committee have a great deal of say in the input and the results. We really need to find out. I suspect it may be that they were oversimplifying the models and getting faulty results,
Right.
or they simply wanted to. They may have intentionally taken this risk in order to deal with an unexpected uptick in rates. They may have intentionally taken the risk internally. Uh, I just don't know. I would find it hard to believe, but I think people have done stranger things than that.
Right. Well, you bring up rates, and the rate environment um, was certainly very challenging, but it was unmistakable the course that the Fed was on. Going way back into last year, the continuous raise in rates, whether it's 50 basis points, 75, then 25, um, which makes you wonder. I kind of identified the Fed induced not induced, but controlled, managed rate increase as a factor that really went against them. That if it had not been proceeding so deliberately, that you'd like to hope that they could have managed it better. But they don't get any excuses in that. Um, but do you have any comment on the rising rate environment over the period where they had all this cash and tried to invest it profitably? Again, they're not off the hook. But what about the impact of the Fed rate scenario increases?
Well, the Fed rate scenarios are supposed to be what the bank is modeling. Everybody wants to know how the bank is going to do, given their balance sheet structure, whether rates go up, down, or sideways. And you want to model it over many scenarios. Given the fact that they probably had a fairly sophisticated model, it would not have been very difficult to determine what the result would have been for the investments and assets that they had and what would have happened in a rising rate environment. And on this one, the bank does not get off very, very easily. First of all, we have certainly been talking about rates coming down, going up for years. It has always been the question that have been asked. We were under falling rate environment forever. And perhaps the answer is one, everyone got lazy. And everyone expected that rates were going to stay down forever. But once it was fairly obvious that rates were going to go up, clearly they had to have had scenarios which indicated the results, especially given the complexity of some of their investments. So I don't understand what they didn't know. I think the one thing they didn't know the volatility of their depositors. You can't have multi-million-dollar depositors who are volatile and not think about the consequences of depositors leaving and forced liquidations in the deposit portfolio. And perhaps this is what ultimately did them in. That's my impression. I can't be sure, but that's my impression. They at some point, no matter what they sold off, they were going to have to absorb the losses in the investments. That is not normally the case. So their liquidity management effectively overlooked the liquidity or lack of liquidity in their assets, investments, and they did not look very carefully at the volatility and liquidity of their deposits.
And that's what actually resulted in a classic bank run.
Yes.
And fomented by the VCs and other large depositors. They were watching for the announcement of that portfolio loss. I think it was 1.8 million, a billion rather, 1.8 billion. And that kind of triggered the run. And of course, they were trying to also raise additional capital. And one question I have for you, Joel, which I haven't seen addressed in many of the articles I've read, is do you think the FDIC acted too swiftly to close them down? I mean, we're talking hours here, but it seemed like all of a sudden there was a run, and the next day the bank was gone by 9 o'clock in the morning on that Friday. Any criticism could be leveled on how it was closed down, or not criticism, but observation.
Well, banks are normally closed on Fridays, so that is true. They always close them on Fridays, and they have the weekend to work out the kinks and understand the balance sheet and so on, which they certainly should have known anyway. So I think that was fairly normal. I simply think that my opinion is, and it's only my opinion, I think the demand for deposit withdrawals exceeded anything that the FDIC or the bank ever could have imagined. And I think part of that is the new involvement of social media. It has been rumored, for what that's worth, that the investment banking industry rang the bell of fear for companies in that bank to pull their deposits. And I think it happened all at once. And it got to the point where it's fairly obvious no matter what they did, they were going to have to absorb enormous losses from liquidation of assets, which ultimately would have diminished capital. Therefore, the FDIC had to step in. I don't think they had any control over the withdrawal of deposits. And a lot of it, I think, was word of mouth, uh, internet word of mouth, and so on. Twitter has amazing power. So,
Right. One other uh, external discipline, if you will, which doesn't seem to be effective, in my opinion, is the rating agencies. You know, they follow all of this too. Supposedly, they have their own. Well, they have analysts, as I've met them, but they kind of go through the same type of exercises that we did at looking at counterparty risk, because people look to them, and it's not so much just about the stock risk, but it really is about financial condition. And I think that S&P notified them, 24 hours before they were going to drop the rating. And that occurred, I don't know, it was on Wednesday or Thursday. So I really call into question the validity of the rating agencies' discipline. And this is something that was questioned a lot more back in the '07, '08 period in that collapse.
yes.
Um, any observations on your part on the role of the rating agencies, maybe the non-role, no impact because it was so late? How could they warn? I mean, a lot of investment committees, they don't look to what the regulators are doing because they don't know. But they do look to the rating agencies as to where they're going to keep their deposits. And maybe some of these Silicon Valley companies look to S&P ratings. So any observations you'd have on the role or lack of the role of the rating agencies?
Well, I think what you said is precisely true. I don't think anything has changed. The rating agencies, frankly, don't have inside information in the same way that the regulators do and the bankers do. They were typically late to the game in 2008 and nine with regard to asset quality, and I don't think that's changed. If anything, they probably have not been focused on the ratings of banks in the last several years because the market has been relatively stable. There has not been a lot of concern and fear in the marketplace. So on the one hand, I don't give the rating agencies much credence because I think they were always late to the game. So I don't think any people in the investment industry put all that much value in the rating agency judgment. So
Right. Yeah, I think that's well stated, and I'm in complete agreement on everything you've said. Well, let's now turn to what I call roadkill of this crisis. Clearly, the C-suite has been wiped out. I don't know, it's not really been clear uh, how far, if at all, they went down into the management ranks below the C-suite. The three top C level executives have been identified, commented upon. Um, but certainly, so they're gone, they're out of it. Of course, they had some of them had sold stock just days before, exercising options and also selling stock. So that's not a good thing, and they'll be held to account at least with questions at hearings. But the shareholders get wiped out in these bank closures, and I think that well, they're supposed to be on their own. That's the capitalist system, but one can't. Um, we want to extend some sympathy to employees, people who are still working there, any kind of employee. I don't know what the employee stock ownership plan was, but probably a lot of officers had opportunities. And those are all wiped out, these people who work there. And in the ebullient confidence
I,
that management always exuded, you would think that a lot of employees said, hey, I want to own part of this story. So, any observations on the effect of the employees being roadkill here, the employee stockholders?
right. Well, I think it's for many, it's really quite tragic. There were many people there for many, many years since the early days of the bank. I mean, some of the people I'm familiar with have been there 10, 15 or more years and are highly competent people and were really not involved in the demise of the bank. So that's one thing. Number two is also not entirely clear what the nature of the employee stock uh, ownership system was. Not all of them involved ownership of the bank's stock. They may be invested in other vehicles. I certainly hope it was more diversified than only owning Silicon Valley Bank stock. So in general, in Silicon Valley, that presents a high risk where people concentrate a great deal of their wealth in their employer company's stock plan. Perhaps this is the exception. Perhaps they were not totally invested in the bank. They were diversified. I don't know. I'm sure they know, but we certainly don't know.
Yeah, but nothing much has come out on that. Well, let's turn now in some of our final comments about Silicon Valley Bank to accountability. And I'm always a real pro business guy and always have been, and particularly, very free market oriented. But I think the US does have an important regulatory system in place, and you can debate over whether it's heavy handed or not, deleterious effects. But nonetheless, management does have accountability, and even more so, I think, does the board of directors has accountability here. I just wonder if any of these people are going to be truly held accountable for what we used to call unsafe and unsound banking practices. And so, what should happen to these people other than a few uncomfortable moments before congressional hearings?
Well, the FDIC is going to consider it pretty seriously. It is entirely impossible to figure out exactly what role any or all of these people played in the decision-making process. Whether it was imprudent, clearly imprudent decisions were made. There's no question about it. From day one, when I heard about it, it appeared that balance sheet management was weak, or they simply looked the other way. My opinion, and it's only an opinion, is that there were those people who were willing to take the risk and willing to look the other way in order to make up for for missing or ignoring the increase in market rates. I think they were willing to take the risk. And I guess when they look through minutes, when they interview people, when they depose people, they will find that pretty quickly who was responsible. I also understand that certain senior people at the bank were allowing their stock options or taking advantage of their stock options well before this occurred, which leads me to believe that perhaps they understood they were taking taking a somewhat risky approach 6 months to a year ago, and were certainly trying to manage their risk in that way by selling off early. I'm sure they'll look at that very carefully. And of course, there's nothing more powerful than ignorance. So that is a distinct possibility.
Right.
I don't believe that people in this bank were ignorant.
Right. That's right. Yeah. Well, of course, it's hard, I think, sometimes to convict people for bad management decisions. Right. That's a very hard case to prove. Right. And I think, frankly, with the Fed's rate increases, you can claim some victimhood on the surface, maybe in front of a jury. That might be convincing to point the finger at the Fed. But I think maybe the stock sales, maybe that's where they can be snared as they should be. But it's very disturbing, again, despite my pro-business attitude, that these C-level executives get away with what they do get away with, and especially in the financial sector, they really get away with it. So, well, I wonder if we, in our remaining moments, we could talk a little bit about First Republic, which is still in play. things are playing out. Keep hearing that maybe Jamie Dimon will come to the rescue, and certainly played a role in First Republic, which I had an acquaintance with, as I did also with Silicon Valley Bank, met some people in the very early days, but also was quite aware of First Republic. And, they catered to wealthy individuals, to entrepreneurs, real estate, and all of that. Um, but part of the story for Silicon Valley Bank and First Republic, I think, was these were cash rich clients, even more so in the case of SVB. So, First Republic, what observations would you have on how they got into the situation they're into now, which is a lack of confidence in the enterprise as the stock collapsed and as deposits have fled?
Well, quite honestly, I'm far less familiar with First Republic, and there is nothing that I know of that would suggest that there's anything in or around the balance sheet at First Republic that would have caused the demise of a bank like First Republic. I think First Republic, unfortunately, is in the neighborhood of Silicon Valley Bank. And I think to some extent they share some similar clientele. And I think they kind of are being dragged down by the Silicon Valley Bank problems. Beyond that, I would simply say the role of the internet, the role of investment bankers who deal at that bank, and their suggestions from investment bankers that they pull money out of some of these questionable banks from their point of view, I think is part of the problem. There's just a lot of talk, unregulated talk, that is causing people to pull money out of banks that appear to look the same, which may not, in fact, be the same. So it's guilt by association.
Right. Yeah, there was quite a big article in Barron's over last weekend about the similar factors of two troubled banks, which was Silicon Valley Bank and First Republic. And there was some discernment about the difference in their business, but nonetheless suggesting, as you did, some factors that would make them appear to be the same, have the same vulnerabilities. So, well, gee, this has been a great conversation. Enjoyed getting your thoughts on all of this, Joel. I'm glad we could confer on this stuff going on. And thanks very much for getting together with me on this.
Well, who would have known back then that we would have been having this discussion? The over 50-year timeline.
That's right. I think on our early years, I forget exactly the chronology, but I'm sure you remember the saga of Franklin National Bank.
Yes.
That was quite a big deal at the time. So
Yeah.
anyway, all right. Well, thanks so much, and I hope that these thoughts will be of interest to folks who view the video.